Welcome to Economics for Managers. In today's fast-paced business world, understanding both micro and macroeconomic concepts is essential for making informed decisions. Whether you're running a small startup or managing a large corporation, economic principles guide your choices every day. In this video, we'll explore how these concepts can be applied directly to support smarter business decision-making. From analyzing market trends to understanding consumer behavior, economics provides the tools you need to stay competitive. Let's begin our journey by defining what economics means for managers and why it's a critical skill in today's business environment. Managers often hear about microeconomics and macroeconomics, but what's the difference? Microeconomics focuses on individual markets, firms, and consumers, helping you understand supply, demand, and pricing strategies. Macroeconomics, on the other hand, looks at the bigger picture: national income, inflation, and economic growth. Both perspectives are crucial for managers. Micro helps with day-to-day operations, while macro guides long-term planning. By mastering both, you'll be better equipped to anticipate changes in the business environment and respond proactively. Let's start with demand. For managers, understanding what drives customer demand is fundamental. Demand isn't just about what people want, it's about what they're willing and able to buy at different prices. By analyzing demand curves, you can predict how changes in price or income will affect sales. This knowledge helps you set optimal prices, forecast revenue, and plan inventory. For example, if you notice demand increases when prices drop, you might consider promotional discounts to boost sales during slow periods. On the supply side, managers must decide how much to produce and at what cost. Supply is influenced by factors like production costs, technology, and resource availability. By understanding the supply curve, you can determine the most profitable output level. For instance, if production costs decrease due to new technology, you might increase supply to capture more market share. Effective supply management ensures you meet customer demand without overproducing, which helps control costs and maximize profits. Market equilibrium occurs where supply meets demand. For managers, this is the sweet spot where you sell all your products without surplus or shortage. Understanding equilibrium helps you set prices that clear the market and avoid costly inventory issues. If demand rises or supply falls, equilibrium price changes, signaling you to adjust your strategy. Monitoring market equilibrium keeps your business agile and responsive to market shift. Elasticity measures how sensitive demand or supply is to changes in price or income. For managers, knowing elasticity helps you predict how customers will react to price changes. If demand is elastic, a small price increase could lead to a big drop in sales. If it's inelastic, you can raise prices with little impact on demand. This insight is crucial for pricing strategies, especially during promotions or when costs change. Understanding your cost structure is vital for profitability. Costs can be fixed like rent or variable like materials. Managers analyze costs to find ways to reduce expenses and improve margins. By calculating average and marginal costs, you can make informed decisions about scaling production or launching new products. Efficient cost management gives your business a competitive edge and supports sustainable growth. Revenue maximization is a key goal for managers. By understanding the relationship between price, quantity sold, and total revenue, you can identify the price point that generates the most income. This involves analyzing demand elasticity and market conditions. Sometimes lowering prices increases total revenue if it attracts enough new customers. Other times, raising prices is more effective. The right strategy depends on your market and customer base. Profit maximization goes beyond revenue. It's about earning the highest possible profit after costs. Managers use marginal analysis to compare the additional revenue from selling one more unit with the additional cost of producing it. When marginal revenue equals marginal cost, you've reached the profit-maximizing output. This approach helps you avoid overproduction and ensures resources are used efficiently. Different markets have different structures: perfect competition, monopoly, oligopoly, and monopolistic competition. Each structure affects pricing, competition, and strategy. For example, in perfect competition, many firms sell identical products, so prices are set by the market. In a monopoly, one firm controls the market and can set prices. Understanding your market structure helps you develop effective strategies and anticipate competitor moves. Managers must choose strategies that fit their market structure. In highly competitive markets, differentiation and cost leadership are common approaches. Differentiation means offering unique products or services, while cost leadership focuses on being the lowest cost producer. The right strategy can help you win market share and build customer loyalty, even in challenging environments. Incentives drive behavior in both employees and customers. Managers use incentives to motivate staff, boost productivity, and encourage desired outcomes. For customers, incentives like discounts or loyalty programs can increase sales. Understanding how incentives work helps you design effective policies and reward systems that align with your business goals. Externalities are side effects of business activities that affect others, either positively or negatively. For example, pollution is a negative externality while job creation is a positive one. Managers must consider externalities when making decisions, as they can impact reputation, legal compliance, and long-term sustainability. Addressing externalities proactively can also create new business opportunities. Governments often intervene in markets to correct failures or promote social welfare. This can include regulations, taxes, or subsidies. Managers need to understand how government policies affect their industry and adapt strategies accordingly. For example, new environmental regulations might require investment in cleaner technologies. Staying informed about policy changes helps you manage risks and seize opportunities. Gross domestic product, or GDP, measures the total value of goods and services produced in a country. For managers, GDP growth signals a healthy economy and potential for business expansion. Tracking GDP helps you anticipate market trends, plan investments, and set realistic growth targets. Understanding economic indicators like GDP is essential for strategic planning. Inflation refers to the general rise in prices over time. For managers, inflation affects costs, pricing, and purchasing power. High inflation can erode profits and make budgeting more challenging. By monitoring inflation rates, you can adjust prices, renegotiate contracts, and manage costs more effectively. Staying ahead of inflation helps protect your bottom line. Unemployment rates indicate the health of the labor market. High unemployment can reduce consumer spending, while low unemployment may lead to labor shortages and higher wages. Managers use unemployment data to forecast demand, plan hiring, and set compensation levels. Understanding labor market trends helps you attract and retain top talent. Interest rates affect borrowing costs and investment decisions. When rates are low, businesses can finance expansion more cheaply. High rates, however, increase the cost of loans and may slow growth. Managers monitor interest rates to time investments, manage debt, and optimize cash flow. Keeping an eye on monetary policy helps you make smarter financial decisions. Exchange rates determine the value of one currency relative to another. For managers in global businesses, exchange rate fluctuations can impact profits, costs, and competitiveness. A strong currency makes imports cheaper but exports more expensive. Understanding exchange rates helps you manage international transactions and hedge against currency risks. Economies go through cycles of expansion and contraction. Recognizing where you are in the business cycle helps managers prepare for changes in demand, costs, and competition. During expansions, businesses may invest and hire more. In downturns, cost control and efficiency become priorities. Adapting to the business cycle keeps your company resilient. Accurate demand forecasting is essential for effective planning. Managers use economic indicators, historical data, and market research to predict future sales. Good forecasts help you manage inventory, schedule production, and allocate resources efficiently. Investing in forecasting tools and techniques can give your business a significant advantage. Setting the right price is both an art and a science. Managers consider costs, competitor prices, and customer value when developing pricing strategies. Dynamic pricing, bundling, and discounting are common tactics. The goal is to maximize revenue while staying competitive and meeting customer expectations. Cost volume profit (CVP) analysis helps managers understand how changes in costs, prices, and volume affect profits. By calculating the break-even point, you know how many units you need to sell to cover costs. This analysis supports pricing, budgeting, and investment decisions, making it a valuable tool for managers. Budgeting is a core managerial skill. It involves planning income and expenses to ensure financial stability. Managers use budgets to set targets, control spending, and measure performance. Regular budget reviews help you stay on track and make adjustments as needed. Effective budgeting supports long-term business success. Managers often face choices about where to invest resources. Economic analysis helps you evaluate potential returns, risks, and opportunity costs. Tools like net present value (NPV) and internal rate of return (IRR) guide investment decisions. Making informed investments supports growth and long-term profitability. Every business faces risks from market fluctuations to operational challenges. Managers use economic tools to identify, assess, and mitigate risks. Diversification, insurance, and hedging are common strategies. Proactive risk management protects your business and ensures long-term stability. Efficient resource allocation is key to maximizing output and minimizing waste. Managers decide how to distribute labor, capital, and materials to achieve business goals. Economic analysis helps prioritize projects and optimize resource use. Smart allocation supports productivity and profitability. Productivity measures how efficiently resources are used to produce goods or services. Managers track productivity to identify areas for improvement and set performance targets. Higher productivity means lower costs and higher profits. Investing in training, technology, and process improvements can drive productivity gains. Market research provides valuable insights into customer needs, preferences, and trends. Managers use surveys, focus groups, and data analysis to inform product development and marketing strategies. Good research reduces uncertainty and increases the chances of business success. Understanding consumer behavior helps managers predict how customers will respond to changes in price, product features, or marketing. Economic theories like utility and preferences guide these predictions. By aligning your offerings with customer needs, you can increase satisfaction and loyalty. SWOT analysis helps managers assess strengths, weaknesses, opportunities, and threats. This tool supports strategic planning by identifying internal and external factors that affect performance. Regular SWOT reviews keep your business focused and adaptable in a changing environment. Break-even analysis shows how many units you need to sell to cover costs. Managers use this tool to evaluate new projects, set sales targets, and make pricing decisions. Knowing your break-even point helps you avoid losses and plan for profitability. Opportunity cost is the value of the next best alternative you give up when making a decision. Managers consider opportunity costs when allocating resources or choosing between projects. This concept ensures you make choices that maximize value for your business. Marginal analysis examines the additional benefits and costs of a decision. Managers use it to decide whether to increase production, launch a new product, or expand operations. By focusing on the margin, you can optimize resource use and improve profitability. Game theory analyzes strategic interactions between businesses. Managers use it to anticipate competitor moves and plan responses. Concepts like Nash equilibrium and dominant strategies help you make better decisions in competitive markets. Behavioral economics studies how psychological factors influence economic decisions. Managers apply these insights to design better products, marketing campaigns, and incentive systems. Understanding biases and heuristics helps you predict and influence customer and employee behavior. Globalization connects businesses to international markets, suppliers, and customers. Managers must understand global trends, trade policies, and cultural differences. Adapting to globalization can open new markets and drive growth, but also introduces new risks and competition. Sustainability is increasingly important for managers. Economic decisions must balance profit with environmental and social responsibility. Sustainable practices can reduce costs, improve reputation, and attract customers. Managers who prioritize sustainability position their businesses for long-term success. Technology drives innovation and shapes economic decisions. Managers leverage new tools to improve efficiency, reduce costs, and create value. Staying updated on technological trends helps you maintain a competitive edge and respond to market changes quickly. Data analytics is transforming business decision-making. Managers use data to identify trends, measure performance, and forecast outcomes. Investing in data-driven tools and skills enables more accurate and timely decisions, giving your business a strategic advantage. Ethics play a crucial role in economic decision-making. Managers must consider the impact of their choices on stakeholders, society, and the environment. Ethical decision-making builds trust, reduces risk, and supports long-term business success. Corporate social responsibility (CSR) means going beyond profit to benefit society. Managers implement CSR initiatives to support communities, protect the environment, and enhance brand reputation. CSR can differentiate your business and attract customers who value ethical practices. The business environment is always changing. Managers must stay flexible and adapt strategies to new economic realities. Continuous learning, innovation, and responsiveness are key to thriving in a dynamic market. Embracing change positions your business for future success. We've covered a wide range of economic concepts that managers use to make better business decisions. From understanding supply and demand to analyzing market structures and economic indicators, these tools help you navigate challenges and seize opportunities. Applying economic thinking supports smarter, more strategic decision-making at every level of your organization. Now that you've learned how economics supports business decision-making, it's time to put these concepts into practice. Continue exploring economic trends, stay informed about market changes, and use data to guide your strategies. With a solid foundation in economics, you're ready to lead your business to greater success.